In February 2026, a company sold 4,551 Bitcoin in a single weekend and walked away with $305 million. Most people never heard what happened next. That company was not a bank. It was not a hedge fund. It started as a car dealership platform in China and became one of the largest Bitcoin miners on Earth. Welcome to the secret treasury, where money, influence, and history intersect. Subscribe to trace the flow of power behind the headlines. The name of this company is Cango Incorporated, listed on the New York Stock Exchange under the ticker symbol CANG, headquartered in Dallas, Texas. Cango was founded in 2010 in China as a platform that connected car buyers, car dealers, and financial institutions to make vehicle purchases easier. For over a decade, Cango operated quietly in the Chinese automotive industry, building networks, processing transactions, and growing its client base steadily. Then in late 2024, Cango made a decision that would completely rewrite its identity. It stepped away from car dealerships and walked directly into Bitcoin mining. The entry was not small. Cango deployed 32 exahashes per second of mining power almost immediately, making it one of the most powerful miners on the planet overnight. An exahash is 1 quintillion mathematical calculations per second. Deploying 32 of them meant Cango was running machines at a scale most companies never reach. By 2025, Cango had upgraded its mining capacity to 50 exahashes per second. That upgrade placed it among the top 3 public Bitcoin miners in the world by installed hash rate. Cango was now operating across more than 40 sites in North America, the Middle East, South America, and East Africa. The infrastructure was truly global. Mining sites were connected directly to electrical grids in multiple countries. Each location housed rows of machines running continuously day and night without stopping. Throughout 2025, Cango produced 6,594 Bitcoin from its mining operations. That number represents real computational work translated into real digital assets on the blockchain. At the same time Cango was mining, it was also holding. By the end of 2025, the company had accumulated 7,528.3 Bitcoin sitting on its balance sheet. That collection of Bitcoin had real market value. It represented a strategic reserve that many investors and analysts were watching with great interest and attention. The year 2025 also brought in serious revenue. Cango reported $688.1 million in total revenue, with $695.5 million of that coming directly from Bitcoin mining operations. On paper, $688 million in revenue sounds like a company doing incredibly well, but the full financial picture told a very different and much harder story. Despite that enormous revenue figure, Cango posted a net loss of $452.8 million for the full year 2025. That is a loss larger than what most companies ever earn. Inside that loss were impairment charges on mining machines, fair value losses on digital assets, and production costs that were rising faster than the revenue coming in. To mine one single Bitcoin, Cango was spending roughly $97,000 on an all-in basis. That included electricity, maintenance, cooling, depreciation, and operational expenses. When the cost to produce something is nearly equal to or higher than what you can sell it for, every unit produced becomes a risk rather than a guaranteed source of profit. Bitcoin miners around the world were facing the same pressure. The reason goes back to April 2024, when a scheduled event inside the Bitcoin network changed everything permanently. That event is called the Halving. Every 4 years, the Bitcoin network automatically cut the block reward in half, reducing the number of new coins miners earn for their work. Before April 2024, miners earned 6.25 Bitcoin for every block they successfully added to the blockchain. After the halving, that reward dropped instantly to 3.125 Bitcoin per block. The halving does not reduce the difficulty of mining. Machines still run at full power. Electricity bills still arrive every month. But the reward for all that work is cut by half. Across the mining industry, profit margins compressed sharply after the 2024 halving. Companies that had built massive operations now faced a math problem with no easy solution. Cango was one of those companies. Its machines were powerful. Its infrastructure was global. But the numbers behind its mining operation were telling a story of growing financial stress. In January 2026, Cango sold 550.03 Bitcoin on the open market. The sale was quiet. It did not make major headlines, but it was the first visible signal of a shift in strategy. 1 month later, the scale of that shift became impossible to ignore. Over a single weekend in February 2026, Cango sold 4,151 Bitcoin in one coordinated transaction. The sale was settled not in dollars, but in USDT, a stablecoin pegged to the United States dollar. The total proceeds came to approximately $305 million in equivalent value. Every single dollar of those $305 million was used for one purpose only. It went directly to partially repay a Bitcoin collateralized loan that the company was carrying. A Bitcoin collateralized loan is a financial arrangement where a company borrows money and uses its Bitcoin holdings as the security or guarantee behind that borrowing. When the price of Bitcoin moves, or when financial pressure builds, those collateralized loans become dangerous. The lender can demand repayment or take the collateral if conditions worsen. By selling 4,151 Bitcoin and using the cash to reduce that loan, Cango was clearing a financial obstacle that had been sitting on its balance sheet like a loaded pressure valve. The official statement from Cango's board of directors described the sale as an action taken to strengthen the balance sheet and reduce financial leverage for the company. Reducing leverage means reducing the amount of borrowed money a company is using to operate. Lower leverage means more financial freedom and less risk of being forced into difficult decisions. But repaying a loan was only one part of what Cango announced that weekend. The second part of the announcement was the one that truly changed the conversation about this company. Cango told the world it was executing a strategic pivot. It planned to take its globally distributed, grid-connected infrastructure and repurpose it to provide compute capacity for the AI industry. In plain language, Cango was saying it wanted to stop being a Bitcoin mining company and stop becoming an artificial intelligence infrastructure provider. That is a significant transformation. The buildings were already there. The electrical connections were already in place. The cooling systems were already running. What Cango wanted to change was what those systems were powering. Instead of powering rows of specialized mining machines solving Bitcoin equations, Cango wanted to power rows of graphics processing units running artificial intelligence workloads for clients. Graphics processing units, commonly known as GPUs, are the hardware that powers modern AI systems. Training large AI models requires thousands of GPUs running simultaneously for days or weeks. The demand for GPU computing capacity in 2025 and 2026 was enormous. Companies building AI systems were struggling to find enough computing power to train and run their models efficiently. Traditional data centers were being built as fast as possible, but demand was outpacing supply. Companies that already owned large-scale power infrastructure had a unique position in this race. Cango was one of those companies. It already controlled power connections across more than 40 sites on 4 continents. Repurposing that infrastructure was faster than building from nothing. Analysts at BitGo described what was happening across the mining industry in February 2026 as a shift from commodity production to industrial real estate. That framing was precise and accurate. Commodity production means earning money by creating something whose price you cannot control. Industrial real estate means earning fixed rental income from clients who need your physical space and power. For Cango, the AI pivot offered something that Bitcoin mining could not guarantee. It offered the possibility of predictable, dollar-denominated revenue that did not swing with the price of Bitcoin. Bitcoin mining revenue is volatile by nature. If the price of Bitcoin rises, revenue rises. If the price falls, revenue falls. If difficulty increases, costs rise while income stays the same. AI compute contracts, by contrast, are typically long-term agreements. A company signs a contract to rent computing capacity at a fixed rate for months or years. The income becomes more predictable. This structural difference between volatile mining revenue and stable compute rental income was at the heart of why so many mining companies were reconsidering their business models in 2025 and 2026. Cango was not alone in making this turn. Across the public mining industry, billions of dollars in Bitcoin were being sold and the proceeds were being redirected toward AI infrastructure investment. Core Scientific, a major public miner, sold $175 million worth of Bitcoin as its own AI pivot accelerated. Its Bitcoin balance dropped from 2,537 coins to approximately 630 coins in that period. TeraWulf, another major public miner, signed more than $12.8 billion in long-term customer contracts for high-performance computing capacity. It ended 2025 with only 3 Bitcoin on its balance sheet. IREN, a publicly traded mining company, had already completed its own transition. By early 2026, IREN held 0 Bitcoin. All of its resources had been directed toward computing infrastructure for AI. Cipher Digital, formerly known as Cipher Mining, called 2025 a transformative year as it redirected its business toward high-performance computing. It sold Bitcoin for approximately $214.7 million. Riot Platforms sold nearly $200 million worth of Bitcoin in the final 2 months of 2025 alone. It was using those funds to finance infrastructure acquisitions and operational expansion. Hut 8, one of the most recognized names in public Bitcoin mining, signed a data center lease in December 2025 valued at approximately $7 billion as it pushed into AI infrastructure at scale. Reuters reported in August 2024 that analysts expected 20% of Bitcoin miner power capacity to shift toward AI data center use by the end of 2027. That prediction was already proving conservative. The scale of this transformation was unlike anything the mining industry had experienced. In just over 18 months, some of the largest Bitcoin operations on Earth were being redesigned from the inside out. The energy infrastructure that made mining possible was the same infrastructure that made AI compute possible. Both require massive electrical capacity, dense hardware, and advanced cooling systems running non-stop. A Bitcoin mining site with direct substation access and the ability to handle 10 or more megawatts of electrical load is the same site that an AI data center operator would want to lease and operate. The difference lies in the hardware inside. Mining machines are specialized for one task only, solving the specific mathematical puzzles that produce Bitcoin. They cannot be used for anything else. GPU servers used for AI computing are general purpose by comparison. They can run training workloads, inference tasks, simulations, and many other types of high-performance computing jobs for different clients. This flexibility made GPUs far more valuable per unit of power consumed in a world where AI demand was exploding and clients were willing to pay premium rates for reliable access to that computing capacity. BitGo analysts noted that repurposing a mining site for AI computing was not simple. AI workloads require Tier 3 style data center standards, low latency fiber connections, and more advanced cooling than a standard mining setup. Tier 3 data center standards mean a facility must have redundant power and cooling systems with no single point of failure and the ability to maintain uptime of 99.98% or higher continuously. Meeting those standards required real capital investment even for companies like Cango that already controlled the land and the electrical connections. The transition was expensive, not just strategic. That is why selling Bitcoin was not just about paying off a loan. It was also about freeing up capital that could be directed toward the upgrades needed to attract serious AI computing clients. The $305 million from the February 2026 Bitcoin sale gave Cango the financial flexibility to pursue that transformation without carrying the weight of a large collateralized debt position simultaneously. At the same time, Cango announced it had secured an additional $10.5 million from a firm called Enduring Wealth Capital Limited, which purchased 7 million Class B shares at $150 each. That investment raised Enduring Wealth Capital ownership stake in Cango from 2.81% to 4.69%, signaling that at least some external investors saw value in the direction Cango was heading. On the stock market, however, the reaction was more cautious. Cango shares were trading around 68 cents, down approximately 43% over the 3 months leading up to the Bitcoin sale announcement. A stock price down 43% over 3 months tells its own story. It reflects investor uncertainty, financial losses, and the difficult reality of a company in the middle of an expensive transformation. Transformation is never a clean process. It requires selling what you have built, accepting short-term pain, and committing to a future that has not yet arrived and cannot yet be fully proven. Cango had gone from selling cars to mining Bitcoin to pivoting into artificial intelligence infrastructure in less than 2 decades. Each shift was its own calculated bet on where the world was heading. The car business made sense when Chinese automotive markets were growing. The Bitcoin mining pivot made sense when digital asset infrastructure was expanding, and returns looked promising in 2024. The AI infrastructure pivot made sense when mining margins compressed, the halving reduced rewards, and global demand for computing power began to outpace what traditional data center providers could supply. Each decision reflected a company reading its environment and choosing to move before it was forced to. That pattern of early movement, whether successful or not, is what defines strategic pivots in history. But the size of the losses cannot be minimized. A net loss of $452.8 million in a single year is a serious outcome, even when revenue is growing and infrastructure is being expanded. Those losses came from impairment charges, meaning the value of mining machines on Cango balance sheet had to be written down because their real market value had fallen below what was originally recorded. When Bitcoin mining machines lose value faster than they generate revenue, the accounting reflects that reality harshly. The numbers recorded in financial statements do not forgive the timing of industry shifts. Cango had entered mining in November 2024, just months after the halving had already compressed the economics of the industry. The timing was difficult, and the financial results showed that difficulty clearly. By January 2026, Cango monthly production had already fallen to 496.35 Bitcoin, down from 569 Bitcoin in December 2025. Average daily output had dropped from 18.35 to 16.01 Bitcoin per day. Declining output alongside rising costs and a falling stock price created a financial environment where holding large amounts of Bitcoin on the balance sheet no longer made strategic sense for the company. Selling 4,451 Bitcoin in February was therefore not a retreat. It was a deliberate repositioning of resources from one type of asset into a new operational direction that the company believed had better prospects. The Bitcoin that had been accumulated as a treasury reserve became the funding mechanism for the next chapter. Assets built in one era were being converted into capital for the era that was beginning. This is how industrial transitions have always worked throughout economic history. Railroads funded telegraphs, oil companies funded petrochemicals, and now Bitcoin miners were funding artificial intelligence infrastructure. Each transition carries risk. Each one requires giving up something certain for something uncertain, and each one is driven by the belief that the future will reward those who move toward it early enough. Cango had placed its bet. The machines were already running across 40 sites on 4 continents. The question now was whether the AI industry would show up to fill them with a new kind of work. The world did not slow down to wait for Cango to complete its transformation. The artificial intelligence industry was accelerating faster than most forecasts had predicted just 1 year earlier. By early 2026, the global demand for AI computing infrastructure had created a shortage that traditional data center builders could not resolve quickly enough to meet what the market was demanding. Every major technology company on Earth was racing to build or rent computing capacity. The bottleneck was not software, it was not talent. It was raw physical infrastructure connected to reliable power. Data center construction timelines typically run between 18 and 36 months from planning to operation. The AI industry needed capacity now, not in 3 years after permits and construction were finished. This gap between immediate demand and delayed supply created an opening for companies that already owned power-connected infrastructure at scale. Cango was positioned directly inside that opening. More than 40 operational sites across North America, the Middle East, South America, and East Africa represented something that could not be replicated quickly, regardless of how much money a competitor spent. Each site already had grid connections, physical security, cooling infrastructure, and operational staff managing equipment around the clock. Those assets had taken months to build and could not be instantly copied. The question was whether those sites could be upgraded to meet the specific technical requirements that AI computing clients expected before signing long-term contracts worth significant amounts of capital. AI computing requires fiber optic network connections with extremely low latency. A mining site located far from major fiber routes would need expensive upgrades before it could serve AI workloads competitively. Cooling is another critical difference. Bitcoin miners produce intense heat concentrated in specific areas. AI GPU servers produce different thermal patterns and require more sophisticated cooling management systems. Power density is the third major challenge. A rack of Bitcoin miners draws power at a certain density. A rack of high-end GPU servers for AI can draw 2 to 4 times more power in the same floor space. Each of these technical requirements represented a capital investment that Cango would need to make before its sites could be certified and marketed to AI computing clients as enterprise-grade facilities. The $305 million raised from the Bitcoin sale in February 2026 was therefore not simply a debt repayment. It was the financial foundation for the technical upgrades the transformation would require. Cango leadership described the plan as a phased transition, meaning not all 40 sites would be converted simultaneously. Specific sites would be prioritized based on location, power capacity, and fiber access. Sites located near major cities with existing fiber infrastructure would move first. Remote sites optimized purely for cheap electricity, but lacking connectivity, would be evaluated separately on their own merits. The AI infrastructure market had already produced clear examples of what successful transitions look like. Core Scientific was one of the most studied cases in the entire industry at that moment. Core Scientific had emerged from bankruptcy in early 2024 and immediately began signing contracts to host AI computing workloads. Its recovery became a reference point that other miners watched closely. CoreWeave, a specialized GPU cloud computing company, became one of the largest customers for mining infrastructure that had been repurposed for AI. Its contracts ran into the hundreds of millions of dollars. These visible partnerships between repurposed mining sites and AI compute operators gave confidence to other miners that the transition was commercially viable and not simply a theoretical strategic idea. Cango was watching these developments closely. His leadership team understood that the window for establishing AI compute contracts at premium rates would not remain open indefinitely as more supply came online. Speed mattered. Companies that secured long-term AI compute contracts in 2025 and early 2026 would lock in favorable rates. Those that waited would face more competition and lower margins on their capacity. This time, pressure was one reason why Cango moved so quickly after the February 2026 Bitcoin sale. Clearing the debt, freeing the capital, and announcing the pivot all happened within a compressed timeline. The company also had to manage its remaining Bitcoin mining operations during the transition period. It could not simply shut off all machines overnight and expect the business to remain financially functional. Mining operations would continue generating revenue while the AI transition was being planned and executed. That ongoing revenue, even at compressed margins, provided operational cash flow during the changeover period. After the February 2026 sale, Cango still held approximately 3,077 Bitcoin on its balance sheet. That remaining reserve gave the company continued exposure to Bitcoin price movements while the pivot progressed. If Bitcoin prices rose significantly during the transition period, that remaining reserve would increase in value, providing Cango with additional financial flexibility and optionality during a complex business transformation. If prices fell, the reserve would decline in value, adding pressure to complete the AI transition quickly enough to replace declining mining economics with more stable compute rental revenue from clients. This dual exposure to both Bitcoin price risk and AI transition execution risk made Cango one of the most complex stories in the entire digital infrastructure sector during the first quarter of 2026. Investors watching the company from the outside had to evaluate two separate bets simultaneously. They had to assess the future price of Bitcoin and the likelihood that Cango would execute its AI pivot successfully. That combination of uncertainty was reflected directly in the stock price, which had fallen 43% over 3 months, even as the company reported $688 million in annual revenue for 2025. Stock markets often punish transition periods harshly, regardless of the long-term logic behind them. Investors price what they can see today, and during a transition, what they see is loss, uncertainty, and change. The leadership team at Cango understood that rebuilding investor confidence would require visible proof of progress, not just announcements. Signed AI contracts would matter more than any strategic statement released to the media. Across the broader mining industry, the same dynamic was playing out at different companies, with different timelines and different levels of financial strength going into the transition period. Riot Platforms, which had sold nearly $200 million worth of Bitcoin in late 2025, was using those proceeds to expand its power capacity at its flagship Rockdale, Texas facility significantly. The Rockdale facility was one of the largest Bitcoin mining operations ever built in North America, covering hundreds of thousands of square feet with direct access to Texas power grid infrastructure. Texas had become a center of gravity for mining and AI infrastructure alike because of its deregulated energy market, which allowed large power consumers to negotiate directly with generators for lower rates. Lower energy costs translated directly into better economics for both Bitcoin mining and AI computing. The energy cost per unit of computation was the single largest variable in the profitability equation for both industries. Hut 8, operating out of Miami, Florida, had taken a different approach by signing a massive $7 billion data center lease in December 2025, committing its future entirely to the AI infrastructure sector. A $7 billion lease commitment is not a hedge or a partial bet. It is a full declaration that leadership believed AI infrastructure was where the future of its business needed to be positioned entirely. These large commitments across the industry were creating a self-reinforcing signal. When multiple well-known companies made similar pivots within the same 12-month window, it validated the underlying logic for all of them. The AI infrastructure transition in the mining industry was beginning to look less like a trend and more like a structural industrial shift, similar to what had happened during other major technology transitions in history. When the internet expanded rapidly in the late 1990s, companies that owned telephone network infrastructure pivoted to become internet service providers. The physical assets were the same. The use case changed entirely. When streaming video replaced physical media in the 2010s, companies that owned distribution networks pivoted to become content delivery platforms. Again, the infrastructure remained while the application changed around it. Bitcoin miners owning power infrastructure and pivoting to AI computing followed the same historical pattern of existing physical assets finding new applications when market conditions created the right economic incentive. The difference this time was the speed. Previous industrial transitions unfolded over decades. The Bitcoin to AI pivot was happening across a single 18-month period, compressing an entire industrial transformation into a very short window. That speed created both opportunity and danger. Companies that moved correctly and quickly would capture premium contracts and establish market position before new supply could catch up with demand and compress margins. Companies that moved too slowly or that faced too many financial obstacles during the transition risked being left behind in an industry where the economics of their original business were deteriorating month by month. Cango had moved. The February 2026 sale of 4,151 Bitcoin was the most visible single action any miner had taken in that period to fund and signal a strategic transformation at that specific scale. $305 million in a single weekend, directed entirely toward debt reduction and balance sheet strength, was a statement that went beyond normal financial management. It was a declaration of direction by the leadership team. The global financial press took notice. Reports in Reuters, the Financial Times, and Bloomberg all covered the transaction and its implications for the broader mining sector and digital infrastructure investment landscape. Coverage in major financial publications accelerated the conversation about what mining companies were becoming. The narrative was shifting from Bitcoin maximalism to pragmatic infrastructure deployment across multiple use cases. Cango itself began describing its identity differently in official communications. The language of Bitcoin mining began to appear alongside the language of high-performance computing and next-generation digital infrastructure services. That shift in language was deliberate. Companies signal their strategic intentions through the words they use publicly long before the physical transformation of their facilities is actually complete and visible to the market. Changing how a company describes itself is the first step in changing how investors, clients, and partners perceive it. Perception precedes reality in capital markets, where future expectations drive current valuations. The 7 million Class B shares sold to Enduring Wealth Capital Limited at $150 each represented a small but symbolically important vote of external confidence in the direction Cango was choosing to pursue. External investment at a defined price point establishes a reference valuation that the broader market can use to assess where sophisticated buyers see fair value for a company in active transition and development. At 68 cents per share on the open market against a private placement at $150 per share, there was a significant gap between what public markets were pricing and what a private investor was willing to pay. That gap often signals that the public market had not yet fully processed the information or fully believed the strategic direction that private investors were pricing into their decision to participate at a higher level. These kinds of valuation disconnects are common during industrial transitions. Public markets move based on visible current performance. Private investors can take longer views based on forward-looking thesis and strategic analysis. Whether the public market would eventually close the gap between 68 cents and $150 depended entirely on whether Cango could deliver visible proof that the AI transition was generating real revenue and real contracts. The mining industry had entered a period unlike anything it had experienced since Bitcoin first attracted serious institutional attention in the years following its initial emergence as a tradable digital asset. Miners had survived the 2018 price crash, the 2020 global economic disruption, the 2022 industry collapse, and the 2024 halving. Each crisis produced a smaller number of stronger survivors with better infrastructure. The companies that emerged strongest from each crisis were the ones that used the pressure to restructure their costs, expand their power access, and position themselves for the next phase of industry development. The AI pivot represented the next phase, and the companies pursuing it were not doing so randomly. They were responding to real demand signals, real contract opportunities, and real capital flowing into the AI sector. Global investment in artificial intelligence infrastructure crossed $1 trillion in cumulative commitments by early 2026, according to estimates compiled from public announcements by major technology companies worldwide. $1 trillion in infrastructure investment creates an enormous downstream market for power-connected computing capacity. Companies that could supply that capacity at scale stood to capture meaningful portions of that spending. The total addressable market for AI compute infrastructure was being measured in hundreds of billions of dollars annually. Even capturing a small fraction of that market at scale represented a transformative revenue opportunity. For a company like Cango, which had reported $688 million in revenue from Bitcoin mining but absorbed $452 million in losses, the appeal of more stable and predictable AI compute revenue was not abstract. It was urgent. The financial logic of the transition pointed in one direction. The execution risk pointed in the other. Where Cango would ultimately land depended on decisions, contracts, and construction that were still being made and built. History does not always reward the companies that pivot first. Sometimes the first movers overextend, run out of capital, and are acquired by better capitalized rivals who learn from the pioneer mistakes and move more efficiently. History also does not always punish the first movers. Sometimes the companies that move first lock in the best locations, the best contracts, and the best talent, establishing advantages that followers cannot overcome regardless of capital. Which outcome Cango would experience was not knowable in March 2026. The transition was underway. The Bitcoin had been sold. The debt had been reduced. The direction had been declared publicly and irreversibly to the market. What was already knowable was the pattern itself. A company born in China to serve car buyers had become a global Bitcoin mining operation and was now positioning itself as artificial intelligence infrastructure for a new economy. That pattern of reinvention, driven by reading economic signals and acting before being forced to, was not unique to Cango. It was a pattern visible across every major industrial transition recorded in economic history. The companies that survived the transition from steam to electricity, from telegraphs to telephones, from mainframes to personal computers, all shared one common characteristic. They moved before the old model collapsed entirely. Cango had moved. Whether it had moved well enough, fast enough, and with enough capital to complete the transformation successfully was a question that only the next 12 to 24 months of operations could answer definitively. But the 451 Bitcoin sold in a single weekend represented something beyond just a financial transaction. It represented a moment of institutional decision, a point of no return in the story of one company restructuring its identity. $305 million does not move without board approval, legal review, counterparty agreements, and a clear strategic plan for how those funds would be used to build something different from what existed before. The decision was documented, announced, regulated, and permanent. Bitcoin that had been mined through months of computational work across 40 global sites was converted into capital and redirected toward a future still being constructed. Every major economic story in history contains a moment like this, a moment where the people running an institution look at the numbers, read the environment, and decide that what worked yesterday cannot carry them into tomorrow. Those moments are rarely celebrated when they happen. They are difficult, expensive, and uncertain. They require giving up the comfort of what is known and committing to the risk of what is not yet proven or secured. Cango leadership made that decision in February 2026. The mining machines kept running. The remaining Bitcoin stayed on the balance sheet. But the direction of the company had changed at its most fundamental level. The story of 451 Bitcoin sold in a single weekend is not ultimately a story about Bitcoin at all. It is a story about how institutions read change, absorb pressure, and make irreversible decisions about their future direction. It is a story about infrastructure, about the physical reality of power lines, and cooling systems and fiber connections that determine which companies can participate in the next major phase of technological development globally. It is a story about the economics of production, about what happens when the cost of creating something begins to exceed the value the market assigns to it, and how rational actors respond to that pressure over time. It is a story about the relationship between one technology and the next, about how the infrastructure built for Bitcoin became the foundation from which a new generation of AI computing capacity could be constructed and deployed. And it is a story about a company that started in China selling car loans, grew into a global digital asset producer, and then chose to redirect everything it had built toward the defining technology race of its era. Whether that choice proves to be correct will be written by the markets, the contracts, the construction timelines, and the clients who decide whether Cango has what they need at the price they are willing to pay for it. The machines are running. The sites are standing. The Bitcoin has been sold. And the next chapter of this story is still being written in real time across 40 locations on 4 continents around the world today. If this story moved you, hit subscribe button. The past holds powerful lessons, and I will help you uncover them.